Hey everybody, welcome back to Chipstock Investor. Today we're going to be focusing on Google or Alphabet. And in keeping with some of our other videos that we've talked about, Google and other hyperscalers CapEx being a good indicator for top chip stock companies like Nvidia and Broadcom.
As you may know by now, Alphabet's power doesn't come from the highly profitable advertising business. More specifically, it's what powers those ads. It's the infrastructure that the digital ads business and more recently, Google Cloud, it's that infrastructure that those businesses are built upon that makes Alphabet such a powerful investment. Take a look at this quote from Alphabet's CEO Sundar Pichai in the Q3 2024 earnings call.
Pichai made the comment that Google or Alphabet is uniquely positioned to lead in this era of AI because of their full stack approach to AI innovation. The first reason for that being is AI infrastructure, which includes data centers, chips, and a global fiber network.
Yeah, that last little bit here in point one, which is what we'll focus on today, if you go back 20 odd years or so in the aftermath of the dot-com bubble, Google is all it was known as at the time, actually went on this spending spree, scooping up lots of fiber optic network that had been built out, a lot of excess capacity built out during the dot-com era. And that helped lay the groundwork for where we're at today. Maybe more on this later on in a future video as it pertains to NVIDIA-based infrastructure being built out, accelerated computing infrastructure. Is there going to be fallout from this at some point in the future? Something kind of like what happened in the dot-com era. We can weigh in on that again in a future video. But Kasey, let's talk about one use for those data centers right now that has been a standout for a couple of years, and we saw an acceleration in results in Q3.
Let's break down the operating income in the key growth outlet for Alphabet, Google Cloud, and how it's benefiting from that infrastructure. You can see that we have that highlighted in pink for you. Cloud revenue is up 35% year over year. Total revenue up 15% year over year for Google. As you can see, Google Cloud is becoming a top driver, not just of growth, but of profitable growth for Alphabet. Cloud operating profit margin of 17% in Q3, helping with the total of 34% year-over-year increase in operating income.
Yeah, that's what led to the really, really big year-over-year increase in earnings per share for Alphabet. So let's break it down a little bit further. Where is Alphabet sticking investments that is leading to this growth in Google Cloud and the big increases in operating profit margin? Because if this continues, Google Cloud is really catching up with the Google ad and Google services business and is becoming a top driver of that operating income, which trickles down into fantastic earnings per share growth for us shareholders. Before we hit that next slide, a word from today's video sponsor, Moomoo.
Moomoo has some great new benefits for new investors or new to Moomoo investors. 8.1% APY on uninvested cash, up to 15 free stocks, and a $30 cash reward bonus when you open your new Moomoo account.
Here at Chipstock Investor, we're expecting a strong closeout to 2024. October was actually a pretty good month. We think that momentum will continue to finish off the year. And of course, in the years to come, this is still a pretty new bull market. So if you're looking for a great way to get invested, Moomoo has a great way to filter investment ideas by ETFs. These themed ETFs cover all sorts of great things like Bitcoin ETFs and, of course, semiconductors, cybersecurity, you name it. If you're looking to invest in some sort of secular growth trend like we do here at Chipstock Investor, you can probably find an index fund to get the job done over on Moomoo.
Moomoo is also one of the cheapest platforms out there, zero commissions on stocks, options, and ETFs. If you're new to Moomoo, use our link in the description below to get started trading today. You get that 8.1% limited time APY on your uninvested cash, up to 15 free stocks, as well as that $30 cash rewards bonus, link in the description below. Okay, back to the show.
Let's take a look at this slide here. We've updated this from past quarters. This is Google's capital expenditures That's spending on capital equipment. In Google's case, that would be things like data center equipment, other networking infrastructure, and other technical equipment they need to operate their digital ads business, and of course, Google Cloud. So this is CapEx to operating cash flow, or OCF ratio. And Wall Street has been fixated on this for the better part of a year. It seems like they've kind of taken a chill pill a little bit here and have come to realize Alphabet might actually know what it's doing when it's investing in data centers and technical infrastructure, including for AI. You can see from this chart, yes, CapEx to OCF is elevated, but it is still well within historic norms. And it was actually at 43% in Q3 2024. So down a bit from Q2, where it had kind of peaked up a little bit, but either way, Alphabet's CapEx still quite normal.
This is Alphabet's free cash flow. On the top, we have the quarter ended in September 30th, 2023. And then on the bottom, we have the most recent quarter that ended on September 30th, 2024. In this quarter, Q3, free cash flow down to about $17.6 billion, down year over year, once again, in large part due to that CapEx spend. But bear in mind that free cash flow is a much lumpier profit metric for an infrastructure company like Google, rather than using GAAP net income and earnings per share.
Yeah, in a recent video, this is why we called a stock like Alphabet and the other hyperscalers a type of hedge. If you also own Nvidia and you're worried about the cycle, Nvidia's cyclicality, and that is driven by what you're seeing here exactly. In years like 2024 and also expected in 2025, when Alphabet spends lots of money on data center infrastructure, Nvidia sales goes up, but eventually there will be a down cycle at some point in the future. And if you're worried about what that does to Nvidia, well, free cash flow would go up for Alphabet in that year. And so maybe it's a nice, easy type of hedge, a way to diversify your portfolio if you're worried about that with your Nvidia or maybe your Broadcom stock. You can see that in this chart here that we made with our friends over in finchat.io. Link below if you'd like 15% off your own subscription to FinChat to make some nice financial visuals like this one. Free cash flow per share is in blue. And of course, because of the elevated CapEx, free cash flow per share is down right now. Earnings per share, net income on a per share basis is earnings per share, a much more smoother line, still going up and to the right. And we expect that will continue.
So what does all this have to do with Nvidia and Broadcom?
That's the $3 trillion question.
Exactly. Google and all the other hyperscalers still have cash to spend and are getting good returns on the investments for their spending at companies like Nvidia and Broadcom. So this bodes very well for Nvidia's networking sales in 2025. And of course, Google and Google Cloud, by extension, will be among the first to get their hands on the Blackwell systems, which are reportedly completely sold out for 2025. We don't know exactly what that means yet, but it's a good indicator.
Probably means a lot of Nvidia revenue, is probably what it means.
Jensen said they're going to sell a lot of Blackwell chips.
Yeah. Okay. Broadcom selling a lot of chips too because of this Google CapEx boom. Similar story here. Broadcom historically makes a lot of high-end networking chips, and those are the chips needed to interconnect all the different parts of that data center. So as companies like Google continue to expand that infrastructure for digital ads, for accelerated computing, for AI, whatever it is they're using it for, Broadcom very much has a piece of that bill. And it's not just the networking chips, though. By now, hopefully, you know from our videos here that it's Broadcom's IP that is actually helping Google make its own custom chips, the TPU. We're now on the 6th generation of that TPU called Trillium. And just like NVIDIA's accelerated computing hardware needs to be interconnected, especially in applications for like AI, be it training or inference, so do those TPUs, those accelerated compute chips that come from that Broadcom IP. So Broadcom, of course, has developed a lot of interconnect hardware to interconnect those TPUs as well. A lot of these hyperscalers like Google trying to scale these things out, to 1 million accelerator chips, all interconnected in a big system so that they can handle massive AI training models and massive inference models, both for themselves internally to help power those Google Cloud data centers. And because of Google's success with these TPUs, all the other hyperscalers are also now interested in doing something similar. It'll be not a TPU, it'll be their own version of it. But this is really good stuff for a company like Broadcom as well, not just Nvidia.
We had a video a couple weeks ago about this subject, Google DeepMind and the Alpha chip. And we talked about how Google and other hyperscalers designing their own chip isn't necessarily a threat, but rather it helps strengthen the whole ecosystem of the semiconductor industry. Google Alpha chip is a perfect example of that.
Yeah, check out that video. Link here in the video or in the description below. So the takeaway here for Broadcom and for Nvidia, we've been shareholders of both for many years now. We're in anticipation, like everybody else, for those earnings reports later this earnings season. But indications from companies like Alphabet and the other hyperscalers are still a really good indicator that the demand is not letting up for this new era of AI, as Sundar Pichai calls it. I think we need to kind of zoom out and continue to just call this the accelerated computing era, not just the AI era. But I guess maybe at this point, this is just an argument over semantics. At any rate, that's Broadcom and Nvidia. Good stuff here. What about Google, Alphabet, and the other hyperscalers? Really, we need to think of these companies not as competitors to the semiconductor industry, but top users of that semiconductor infrastructure as they build out what is really just a modern utility.
Yeah, if you think about it, they're building out the infrastructure for these utilities, and then they're just collecting that stable service and rent revenue over time, just like your electric company.
Yeah, or water, or whatever it is. In this form, though, it's computing as a utility delivered via the cloud, via your internet connection, or for the business that you work at, probably using some sort of cloud product at this point and accessing that computing happening at a data center via an internet connection.
And ultimately, as far as we can tell, there's no slowdown in infrastructure development, at least in the immediate term future. But let's talk about Google's valuation.
Yeah, we're very happy with Alphabet continuing as a core portfolio position, especially after that Q3 report. It was another really good one. One more slide we have here for you from FinChat. We've been doing a lot of slides recently outlining reverse discounted cash flow to try to figure out what fair value is on a stock. Let's do something a bit simpler this time. We do use multiple valuation methodologies when we're looking at a stock. That's the very, very last step in our process and our framework, if you will. But here's another one, the PEG ratio. We have it highlighted there in blue, right in the middle of the screen. I think this PEG ratio is based on a 1 year forward earnings per share growth outlook for Alphabet. Anything less than 1.0 considered to be a pretty cheap growth stock. So at 0.75, Alphabet looks quite undervalued. If you go out a few more years, their earnings per share growth rate expected to moderate a bit. Either way, Alphabet at the very least looks quite fairly valued at this point.
Now, some of that cheapness or fairly valuedness probably has to do with something with the DOJ lawsuit. We're not exactly sure what the result of that will be. We're awaiting the punishment that the DOJ will level out Alphabet, and no doubt Alphabet will string this out with appeals as long as possible. So we'll have to wait on that. Ultimately, we are still very happy with Alphabet in our portfolio, and we view it as a nice complement to our positions in Nvidia and Broadcom, which by our definition are still new secular growth leaders in this market.
Yeah, this new bull market, let's call it the accelerated computing bull market. That's really what this is all about. And that is what is driving the top stocks right now in this stock market. So we're happy with these positions, leaving them as it is. Good job, Google, Alphabet in Q3.
I can't wait to get the new Blackwell upgrade.
It's coming. Maybe January?
Maybe.
We'll see.
Sold out to us here at Chipstock Investor.
Stay tuned, folks.
Thanks everybody for watching this episode. Make sure you've subbed to the channel and check out our Semiconductor Insider membership. Just $5 a month gets you answers to all of your questions on Discord.
all of our content, all of our research. It's all there. That's where you'd find it.
See you all again very soon here at Chipstock Investor.